Hey guys, it's Javi, and today we're going to really help you understand how to figure out your own mortgage payment, because what's going to happen is you're going to be looking at houses, you're going to be looking at things online, and you're going to be giving these calculators that are like way crazy, make things seem way better than they actually are. Or maybe you're like going to be looking at houses and you call your lender and now you're waiting 2 days to get a call back just to get an idea of what a monthly payment. Now, I'm going to show you in today's video how to get a general idea, like how to get a general vibe for your monthly payment. This does not substitute an actual quote from a lender, an actual pre-qualification, okay? So just a heads up. And of course, for those that don't know who I am, my name is Javi. I make videos like this to help you understand the home buying process so you don't get taken advantage of. And all I ask for in return is when you're looking to buy and you're in the Phoenix, Arizona area, think about me or use any of my great resources down below. We got a great home agent referral network. If you have wanting to buy anywhere but Phoenix, they're amazing people. Check them out. And also, of course, my home buyer resources that we'll be using in today's video as well. So, okay, let's talk about this mortgage situation. So first and foremost, I don't care what you use. I don't care if you go on Google and you type mortgage calculator. I don't care if your favorite freaking aunt has a mortgage calculator that she sent you on Google Drive. Generally, the math works the same. In today's video, I'm using mine, but just as because this is what I like using, I'm quicker with it. It's what I use all the time. So, but it doesn't have to be this one. We have to understand first the 5 aspects of a mortgage payment. First aspect is going to be your principal. Second is going to be your interest. This is going to be your actual loan payment. And this number will always remain the same for the 30-year span. What adjusts that number is your loan amount or your interest rate. If the interest rate is lower or the price is lower, that number goes down. If the interest rate goes up or price goes up, that number goes up. The third one is going to be your home insurance, your actual hazard insurance. You are required to have it as part of your mortgage payment. If you're putting, I believe, less than 20, or even if you are putting 20, you need an exception from your lender. Usually this is an annual premium. Let's say they charge $2,000, $1,800, $1,500. You pay that once a year. Well, technically you don't pay that. You're paying a 1/12 of each payment with your mortgage payment, and the escrow company or the escrow servicer will make that payment for you. The fourth one is your property taxes. Same situation, except a little different. Every county is different. Here in Arizona, we pay them every 6 months and they're paid in arrears, not in the rear, in arrears. So basically you pay the last 6 months on when it's due. So let's say you pay, $2,400 a year, you're paying $1,200 every 6 months. Well, in this case, obviously, if you have a mortgage company or you have an escrow, that they're paying for you and they're calculating their best of what they're thinking it's going to be. So if they're ever wrong, they will then go to you and say, hey, we were off by $600. Do you want to send over that money, or should we just take more from you for the next, 8 months or whatever? So I know that's a whole big old camel word. Can't even talk. Can of worms. So this is going to be the 5 factors that affect it, okay? And like I told you, what affects it truly is going to be the purchase price. So these are the 5 things that we're going to figure out together here. So the main components of what makes up your mortgage payment is going to be as follows. Your purchase price. So let's say in this case, we're buying a $400,000 house. Your down payment. The more down payment you put, the less your starting balance is, and overall, the less payment you have. Next is our interest rate. This is completely market rate and totally dependent on your lender you're working with. There are some options that you may have, like buying down your interest rate if you want to go that route. You don't have to, but it is an option if you want to buy that down. We'll kind of explore a little bit, talk about that a little bit later. And the last is your loan term. Most people buy a 30-year loan nowadays. There are starting to be more 40-year options out there, and there are those that believe 15 years is the way to go, but just the standard that I've seen almost every time is 30 years. Just heads up, that's how it works. Now, the actual formula to figure out this specific number is really complicated. So we're not going to focus on that specifically. What we are going to focus on is how to calculate the interest. So this number right here is that number I told you that will always remain the same for the whole entire 30 year. And we can see here in this amortization schedule, you see 240186. That's the same payment, baby. But what you see here is that the interest right here starts off very high. As a matter of fact, the majority of this payment is actually the interest, and only $343 worth of this is the principal. And as we progress and progress and progress, this number never changes. What changes is the ratio of how much is borrowed interest and how much is principal. How do we know this? How does this work? I can explain this. This one's a little bit easier to understand. How you calculate what you pay in interest is you get your current loan balance. And of course, your very first payment is going to be your starting balance. You get that number, you multiply it with the interest rate, and you divide it by 12. If we were to use a calculator, this is how it would look like. We would use our starting loan balance, multiply that by 0.065, divide that by 12. So our first monthly payment of interest is $20.58, and that's how we get that number. How we figure out our principal is quite simple. We just subtract that number minus the interest, and we get the principal paid. And what we see here is that $343, that little tiny bite, gets taken off the balance. So now the next month, we do the same exact formula, but we're not going to use a starting balance. We're going to use $379,656 with 47 cents because we removed the $300. So that's why the majority of the interest gets paid at the beginning, because the balance starts so high and eventually slowly starts going down. And the problem with this approach is if you do end up paying it, like for example, this $400,000 house, you're going to pay a total of $484,000 of interest on top of the $380,000 in principal you're going to pay. So if you always do this approach, you will always, the bank's going to just make a killing off of you. Next, we have the hazard insurance. This is going to be tough for you to figure out, but if you're already working with a real estate professional or insurance professional, call them saying, hey, this is the type of house I'm looking for. What does the home insurance usually look or run about? And they can literally pull up some old file, at least if they're experienced, they can, of like recent houses in the area and what the insurance policy was. So, I'm going to, in my state, things are kind of cheaper. So I'm going to put like $1,500 a year. So property taxes here as well. You have to get your annual amount. Usually tax information is public knowledge. So you can just, when you're looking up a house, it'll say there what the property taxes per year are. So let's say they're like $2,000 a year. You would put $2,000 here. And now this is mine. Obviously, other calculators will give you the ability to adjust this. Some might have it in a monthly format. Some might have it in an annual format. So if it's a monthly format, then you would just have to get 2,000 divided by 12. Mortgage insurance is going to be the one that's a little more difficult, because here's the thing. If you're going FHA, it's always going to be 0.55% of the loan amount. And how you figure out the annual amount is you get the loan amount, the starting loan amount. This doesn't change every time your loan gets lower. It's your original starting loan amount. That's the number that stays there permanently. So in this case, it was 380. Was it 380? Well, in theory, it wouldn't be this one. FHA is 3.5% down, so it would be 386. So 386. Sorry about that. 0.0055. And that's your annual PMI. But if we break it down further, divided by 12, that's the amount that you're paying for the rest of your life, 171. So here, if we put 2123, because that's what we're going to pay annually for the rest of the mortgage for FHA, we put that here, then the monthly amount is 176.92. Once again, it's only based off your starting balance. It does not decrease as you pay off your balance with FHA. Hey, it's me in the future. Yes, I decided to shave my beard and now I look like a narco. So I just wanted to add that I added this FHA little box here. So if we are calculating an FHA mortgage, you should click this box, because that is going to increase your starting balance by the amount they're going to charge you for that mortgage insurance premium I just explained. So if you're going FHA, click this little box, or if you're using a mortgage calculator, make sure that you add that 1.75% of the loan balance, right? So this button, all it's really doing is it gets your loan balance and it adds 1.75%. So cool, because you want to calculate that, because it does affect not only your monthly payment, as you can see here, but it affects how your taxes, like you pay a total of, what's that, $8,000 more of interest over your life of your loan just for that freaking amount. So cool. With conventional, It varies. Here's the thing. There's a complicated formula that no lender will ever tell you up front what it is, because you won't really know, because it's based off of two things. It's based off your risk factor. If you are someone with extraordinary credit, like a 900 credit score, and you're, putting 10, 15% down, you could have a PMI as low as between, 0.1 to 0.3%. And this is your annual amounts, right? So let's say we are going conventional. We're going 5% down. And, let's say you do have, I talked to a lender today and I asked her, hey, what's a situation where it would be this low? They're like, yeah, if someone's putting 19% down and they have really amazing credit, it's going to be like ridiculous, like $380 a year. And obviously this falls off. That's like freaking $31. And this falls off like a year later, because you're with conventional, your PMI falls off after you pay off 22% of the mortgage. So, or you can just put 20% down originally and get rid of it. It's super rare to get something this low. It's like really like you have to have like a 900 credit score and have to have a really good down payment, not 19 but like 10 or 15 or something. So most people are going to be in this range between 0.3 to 0.6%. This is your good credit score, decent down payment. We're not talking anything crazy. 5 to 10% down. Credit scores like 750 to 800. Nothing too amazing. If you're like in the low 700s, you might be between 0.6 to 0.8. And if you're like below, like in the 600s and you're going conventional, it's going to be here. And as you can tell, FHA is 0.55, right? So at this point, if your PMI is 0.6 or above, you should really consider, why am I going conventional? If you are paying a much higher interest rate, because conventional usually is a higher rate, and you're paying your PMI higher than FHA, it doesn't really make sense at that point. In this case, let's assume you're very standard and you're going to be at $1,900 for 5% down. So we're going to put $1,900 here, and that's going to be the monthly payment here. First payment day, today's April 14th. So let's say we're closing today. So your first payment would be June 25. So now we get our monthly payment. Our monthly payments consisted of our principal and interest, which in this case is $2,401. Our insurance, which is our annual hazard insurance divided by 12. Your taxes, which are your property taxes divided by 12. And then your mortgage insurance, which depending on your risk factor, you're going to give a very educated guess of what that looks like. Now, once again, to calculate these numbers, if you're not using any of these formulas, it's quite simple. So it's, let's say you're like, hey, man, my credit's pretty good. I'm putting a good down payment. I think I'm gonna be at 0.30. Well, you get your starting loan balance, which in this case would be $380. You multiply that by 0.003, and that is your annual PMI that you're paying for the rest of conventional is not the rest. It's for conventional. It's until you paid off 20% of your house. If you want to know your monthly amount, you divide this by 12. But the way my thing is set up is you would put the annual one right here. Make sense? But anywho, all that adds up to about $28.51 with 86 cents. Now, here's the thing where things can get interesting. Like, what if you're talking with your lender and they're like, hey, man, we're going to offer you, if you were to put an extra, $3,000 down, you can buy your rate down to 6.4 or 6.3, right? Well, at that point, you have to calculate the value here, because if you buy, let's say it cost you, $5,000 to buy down to a 6.3, what happens? Well, if I put 6.3 here, let's look at what happens with that monthly payment here. That really didn't drop that much. That dropped, what is that? $50, $466. So you saved maybe a little bit less than $20,000 of interest over the life of the loan. So it's helpful, but really, if you think about it, you save $50 a month. That's about $600 a year. Okay. So if it costs you $5,000, does it take you about 8.3 years to kind of split the difference? And yes, in theory, you're paying less interest over time, but you want to consider these things. You want to really make sure to evaluate, see if it's the right situation. Also, maybe if you go FHA, that interest rate's like 6.1 or 6.2 or so. You kind of have to just really, account for the difference. And now, please, when you're working with a lender, you're getting pre-qualified, have them give you the numbers in a form so that way you can compare them side to side. This is more or less to help you understand when they send you those numbers, or if you're early on in the stages, how to do it yourself. So with that being said, yeah, you can get a good idea of how to calculate yourself, or even use any of those online calculators. And when you're using them, you can have a better idea of how they work. And when you are talking to a lender and they are giving you an estimate, you can look at those numbers and be like, hey, why are you estimating my taxes to be about $5,000 a year when the taxes I'm looking at in my neighborhoods are going to be like $2,000? Hey, look, your interest rate is 5.8, which is amazing, but you're charging me this rate buy down. Like, I don't know. You just have a better understanding. You might have to watch this video once or twice to really understand it and play around with the calculator. One last thing I want you guys to really leave this video knowing, and I think this is really important because everybody's terrified of doing this, is really get comfortable with an amortization schedule. Okay, this is the scary document that people, when they're signing, they just push away because it's too scary. It lets you know exactly what each payment is doing if you were to never make any extra payments. And yes, it is pretty depressing to see how small your balance drops, how much interest you're paying to date, and because it's terrifying. But just there's power in knowing how it works, because hey, check this out. If, let's say, we were to put an extra $500 on month one, we can see a chain reaction that happens. We decided to put $500 extra towards the principal on your monthly payment. What did that do, really? So you shaved off about a year and a half almost of interest, and your interest paid now is $451, not the higher number that it was before. Do you remember what it was? I don't remember. But you can just rewind. I can't. So, and let's just say you made a habit out of it and you made that for the next, let's say, first 5 years. How's that look like? Well, because you did that, now your house is going to be paid off in 24 years and your total interest paid is $364. So having that extra payment. So let me ask you this, my friends, why is this happening? Why is making extra payments towards your principal dropping off so much freaking interest? In this case, we did for the first 10 years, we put an extra $500 each month. And now our house is paid off in 21 years or 22 years technically, because if we round it, and we've only paid $310 interest, which is less than the actual purchase price. Now, why is this happening? Well, remember, the interest formula is calculated off the previous loan balance. And if you're putting an extra $500, remember that first payment, they only $300 got applied towards the balance. Well, now it's not just $343 that got applied, it's $843 that got applied. So now the next formula uses the lower balance, and then it keeps compounding more and more and more, and eventually, shoot, man, you can have this house paid off. But of course, this is something just to consider. And overall, I hope you have a better understanding of how the mortgage payment works. I hope that gives you more power when you go and you negotiate, when you're talking to mortgage companies, because they tend to throw these big words at you, and they kind of just like throw glitter at your face and hope that you don't ask any questions. So hopefully you have now a better understanding of how everything works. So thank you guys so much for watching. Once again, if you are interested in downloading the actual, not only this one, but a bunch of other worksheets I have and spreadsheets I have, check out the Home Buyer HQ, links in the description. You get access to all the spreadsheets here, including the one I just showed you that just made that today. So it's pretty cool. You can download it for free just by typing 0 and saying, I want this. But if you have any extra change, just, I don't want to make a fool of myself. You get it. But I appreciate anyone who put something there. Also, if you guys are, and of course, if you're looking for an agent anywhere, except Phoenix, Arizona area, use homemoney.com/Javier. Just click here, get a click buttons clicked and whatnot. And of course, if you're looking to work with me in the Phoenix, Arizona area, I also have a link or my website for you to check out and schedule an appointment with me. So I appreciate everyone watching this. Thank you so much. Blessings to you all. Use this mortgage knowledge for good.